Welcome back to Markets Today. We're having a very interesting and deep conversation in as far as derivatives are concerned. As you can see, I have my pen and paper, taking down notes, trying to understand what decisions do I need to be taking today. We are joined in the studio via call by Terry Adembesa. He is the Chief Officer for the Derivatives Market at the Nairobi Securities Exchange. Welcome back, Terry.
Thank you.
An overview of what do I need to be doing if I'm looking at the derivatives market. So I need first to do research in as far as understanding the underlying drivers for the stocks. Then I take a position. And basically, if I'm bearish on the spot market, if for instance I think Safaricom will go to 35, then I should do the reverse in the derivatives market. Correct? Is that
And that basically is if your trading strategy is really to mitigate the risk around the security that you're holding on the underlying. Yeah.
what else can I use derivatives for? Firstly, you said I can use it as a risk mitigation strategy. What other strategies are there when it comes to derivatives?
There are a number of different uses you can do it. One of the key ones, of course, right now is that because of the high volatility we've seen in the markets, there's really quite a bit of activity that you can benefit from in terms of the fluctuation in prices. So the fees, the trading fees for derivatives are much lower than the fees for the spot market. So you're then able to take in different aspects of you know ability to trade by in and out, even on a daily basis, so that you're able to take different what do you call it, like make some money, some profit based on the volatility on the different prices. One of the things you'd see, for example, the Safaricom, for example, has an average price movement of about 40 points, right? Based on the 40 points, the daily ticks in which the security moves on the spot market is about 40 ticks. On the spot market, it's about 6 ticks. The price, the fees that you are charged on the spot market is would take you about 19 ticks for you to break even on that trade, while on the future side it would take you about 9 ticks. Okay, so let's look at the future side. So if your break even is taking 9 ticks, which is really a factor of the fees that you're paying towards that single trade in and out, and the average tick movement is about 40 ticks. It means you're able to get in and out of that trade even intraday and still make money on that trade. Okay, so if you're an active trader who's you want to get in and out of various trades, you're then able to make some money based on those price movements. Of course, COVID has created quite a bit of volatility, and thus you're then able to do this.
So, what other considerations should one bear in mind if you want to actively participate in these derivatives? You've walked us through the trajectory of some of the stocks. Perhaps you can tell us what else is in your presentation and what we need to focus on.
There's a number of factors, and let me show you on the slide what has happened for the first quarter. If you can see that, if you're short on the securities, remember the curve that I showed you. If you're short on the securities, you possibly have made a return of close to 200% to 360% on the index if you are short on the security. Vice versa, then it also means that you'd have made quite a big loss if you are long on those securities, okay, on the futures. Of course, the underlying all lost money, so your returns would be 21 to about 24%, 28%. 28%. the underlying. So one of the things you want to do is make sure that you're doing your daily monitoring your positions, and if the price is going against you, then you're getting out of that trade. You're trying to offset that trade to minimize your risk. So the thing with the derivatives market is that you don't hold the contract, for the entire duration of the contract. You can get in and out as you deem fit to minimize your losses if you're on the loss side of that trade.
So I've seen some interesting numbers there. Are those indicative or are they realistic? I've seen 300% return on some of the single stock derivatives there. I think it was Safaricom or one of the banks. Is that an actual return that was earned in the first quarter, or is it a sample or an illustration of what kind of returns one would get?
Returns on the first quarter, on quarter one 2020, for somebody who was short on the security, on the various securities. Yeah.
Is the volume growing? Is there interest, and is it local or is it foreign?
Volume is mainly local. Of course, even on the spot market, we've seen that there's been a sell-off by the foreign clients. So volume has been mainly local. It's still quite thin. I think as many people still try and understand the product, then you then have many people gradually getting to participate. But for now, it's still quite thin. We have good interest. We have people asking the right questions. Participants like fund managers, local fund managers asking the right questions. Some are doing their research reports. We're getting towards the end of a quarter where reporting is coming up and advice to clients. And so some of the analysis and briefs to clients. So we've had interactions with fund managers asking and for help towards putting some of those briefs together.
Fair enough. I think that's we are coming to the tail end of the amount of time that we had. But you can send us off by telling us, what should I do today if I want to look at derivatives? Should I put money in it? Should I go long? Should I go short? And really, who qualifies to be in this place? Because you don't want somebody who's necessarily starting out on their investments and the first thing is derivatives and they don't understand and then they depend. Who would you recommend this product to, and what are some of the trading strategies you would be advising them to take?
The thing is with any financial investment, participation in any of the financial markets, it's important that you understand the security, you understand what is happening on that particular market, and of course you're seeking advice from your broker, from your research analyst and that kind of thing. But the markets are open for everyone. It's not restricted to retail or to institutions. The markets are open for everyone. So the ability to find out what's happening, there's all this stuff that we've put out for your education on the NSE website. You can get stuff off Google. You can speak to your research analyst. They'll tell you what to do. You can walk to your broker. We have a list of the brokers who are participating in the futures market on the NSE website. So if you go there, you have a list and you're able to knock and talk to your clients. Many of these brokers are also, because of COVID, have put in place measures around working offsite access to them. So if you call or you link up with them on email or on Zoom or whatever, you're able to access them and they'll give you some research and some walkthrough on how you can participate.
Fair enough. Thank you so much. That was Mr. Terry Adembesa. He is the Chief Officer of Derivatives. It's not a very easy topic to understand, but there is a lot of material, and I hope this session has been beneficial to you. I want to imagine that you can be able to access much more of the Nairobi Securities Exchange website and consider how you can be able to trade this with the ongoing volatility on global and local stocks. Thank you so much for your time. That's all from us today. See you tomorrow, same time. Good day.